If you are planning to leave Germany, you might have to pay an exit tax. And the basic idea is that Germany wants you to pay additional taxes before you leave German tax system. Some people think this exit tax applies to anyone leaving Germany, which is wrong. Most people who leave Germany will not pay the exit tax, but the people who do fall into it can have a serious problem. Basically, to be obliged to pay this tax, you need three things. You lived in Germany long enough. More specifically, being subject to unlimited tax liability in Germany for at least 7 years from the past 12 years. You own the type of assets the rule cares about, which I'll share in a moment. And your move means Germany loses or restricts its rights to tax the gains later. By the way, if you're new to the channel, my name is Ehsan and I share how to build wealth in Germany. And if you are one of the lucky ones who has built wealth here in Germany, you could be obliged to pay this exit tax. And unfortunately, most of the conversations cover company owners. But you're not a founder and you don't own a company. For many people like you, exit tax probably won't be the main issue. You still need to handle tax residency, deregistration, and all the normal leaving Germany things. But still, there are three situations that look ordinary but cause you to pay the exit tax. First is real estate. Say you bought an apartment back when people still called it affordable. You live there for a few years, then move abroad. Does Germany's exit tax apply just because you personally own German real estate? Usually no. Personally owned German real estate is not the classic exit tax case. Germany usually keeps the right to tax German real estate even after you leave. So if you sell later, Germany can still apply the normal real estate tax rules. Things like the 10 years speculation period for privately held properties would apply. But that's not the same thing as exit tax. Now change just one detail. The apartment isn't held by you personally. It's held by a company. Maybe you own a GmbH and the GmbH owns the apartment. Maybe it's a Bulgarian or a Romanian company that owns the property. You might say you don't own the apartment. The company does, but you own the company. And Germany's exit tax can apply to company shares. So when you leave Germany, the assets being tested may not be the apartment directly. It may be the value of your company shares, which happen to derive from real estate. Same property, but the tax results are totally different because of the structure. So please be careful when coaches tell you this kind of tax optimization. Second is ETF investments. From 1st January 2025, Germany expanded exit tax rules to certain investment holdings. This can affect someone like you who has a savings plan that runs automatically in the same ETF. Years pass and your purchase cost in that one ETF reaches 500,000 euros. Then you move out of Germany. From 2025 onwards, that's something you need to check. If you have 20 or 80,000 euros in ETFs, this probably isn't your concern. But if you are a high saver, a high earner, part of a dual income household, and you have more than 500,000 euros of purchase costs in one single fund, get advice before you move. Because a lot of expensive tax mistakes start with, I assume this did not apply to me. And the third one is the most common. The most common and number 3 is foreign companies. A lot of people living in Germany start companies outside Germany. Maybe the administration seems easier, the corporate tax is a little bit lower. Or someone on YouTube said, just open a company in Bulgaria and forgot the small detail that you still live in Germany. You start a Bulgarian OOD, a Romanian SLR, an Estonian OU, a UK private limited, or one of the many other options. You own 100% of it. And obviously at the start, the company is worth almost nothing. But your business grows and after a few years, you leave Germany. You might think Germany cannot tax this. The company is Bulgarian. But that's not how this exit tax works. Germany doesn't only care whether Germany is registered or if it's a GmbH or something else. Germany also cares that you were a German resident while the value increased. If you own at least 1% of a foreign corporation, meet the residence conditions, and your move affects Germany's right to tax the gains later, the exit tax may apply on the unrealized gain in those shares. The country of incorporation is not a magical shield. What applies is how long were you a German tax resident? What percentage of the company do you own? What is the worth now versus what you paid? Did the value increase while you lived in Germany? And will Germany lose or restrict its right to tax the gain after you move? So when someone says, I don't have a German GmbH, I only have a Romanian SRL, that doesn't automatically close the question. Maybe the rule applies, maybe it doesn't. But the foreign registration doesn't make it disappear. This might surprise most of you because people think about their company by where it's registered, while Germany thinks about it based on where you are living when the value went up. What about freelancers? If you operate as a freelancer or a sole proprietor without a corporation, the classic exit tax on corporation shares may not apply because there are no corporate shares. But that doesn't mean you leave without tax questions. You may still need to think about business assets, final returns, VAT, permanent establishments, and where the business is actually managed from after the move. Please hit the like button if you're getting value from the video, and let me know in the comments what you did not like about the video. And if you think the video was perfect, just drop a thumbs up emoji in the comments. So how is the German exit tax calculated? Let's use a simple example. As a founder, you own 100% of a GmbH and you paid 25,000 euros for the shares. Let's say when you leave Germany, the company value is at 1,025,000 euros, resulting in the unrealized gain of 1 million euros, which may be taxed. For privately held substantial shareholdings, the partial income method commonly applies. Under that method, 60% of the gain is taxable and 40% is tax-free. At the top income tax rate of 65%, that means 600,000 euros taxable, meaning up to 270,000 euros in taxable income alone before solidarity surcharge. This tax is on the gain, not the full company value, which can often lead to a cash flow problem. If you sell a company for €1 million and pay tax, you may hate the bill, but at least cash arrived. If you move abroad and owe tax on a company you still own, that is a huge problem. The value may be trapped inside the business because the valuation may be theoretical. But can you pay this exit tax later? Sometimes there is a relief. In some cases, the payment can be spread over 7 annual installments rather than everything being due immediately. But an installment plan is still a tax bill with paperwork and conditions that can make the remaining amount due sooner. There are also temporary return rules. If your move is genuinely temporary and you become German tax resident again within the allowed period, the liability can potentially fall away retroactively if the conditions are met. But I might come back one day is not a tax plan. Germany does not run on vibes. Here you have forms, deadlines, and very specific conditions. For your ETF portfolio, the German exit tax will be a capital gains tax, which is 25% plus solidarity surcharge minus any 4-hour pauschale you have already paid. Now at this point, you might think that only rich people need to worry. Not exactly. The rule looks at assets, thresholds, ownership, and unrealized gains, not how wealthy you feel. A person with a 700,000 euro company may have very little cash. A person with 520,000 euro in one ETF may just be a disciplined saver. The rule doesn't care about your self-image. It cares what you own. What to actually check before you leave. Start with how long you have been a German tax resident. The 7 out of 12 years rule is the key starting point in most cases. Then list everything you own, not just German assets, everything. Check whether you own at least 1% of any corporation, including foreign ones. Check large fund or ETF positions. If you have around 500,000 euros or more of acquisition costs in one ETF or investment fund. Even if you have not reached the 500k point, it's probably a good idea to use another ETF from a different provider. Even if the ETF you invest in is the S&P 500, the one from iShares will be considered as different ETF as one from Xtrackers. Check how your real estate is owned. Personally owned property and company owned properties lead to very different outcomes because Germany's exit tax is not a general tax on everyone leaving. Most regular employees with modest portfolios probably won't pay it. If you're planning to leave Germany and you own a company, have a large ETF position or hold property through a company, speak to a qualified advisor early. Moving countries is already annoying enough. You don't want to discover a major tax issue when the boxes are packed and the flight is booked. It's not all bad though. There is one condition where you can even get your social contributions back when you are leaving Germany. In this video, I share how you can get your pension contributions back when leaving Germany. And in this video, I share how to start a business in Germany.